Hello traders, Steve Ganz here. Now I have a question that a viewer sent in regarding the butterfly series that I did, and there was also some other questions that actually came up in the comments section. So I wanted to take this time to kind of address some of the things I saw there. I found those pretty interesting, and I guess I've traded these for so long that I took a couple of things for granted that may need further elaboration. So let me start with this question from Ron. Now, Ron actually, I believe, emailed this question into Heath, but anybody that has questions, please make sure you just put them in the comments down below. I do read all of those. I try to respond to the vast majority of them. And so that's probably the best place for me to see them and potentially respond. But there's two main things I want to address. The first one is this question here from Ron, and he has a couple questions in here. And then I've got one other one I'm going to cover. So the first thing here is, why is it my go-to trade? I seemed emphatic about that. I am. This is my go-to trade. This is one of the most common trades I make. For the reasons cited, it's very easy to adjust. It's easy to manage. But his point here about, am I talking about an iron butterfly, not a butterfly? Just a butterfly could be an all put or an all call butterfly. So credit is gained, but the price still must be close to middle strikes at expiration or near expiration to achieve any profit. Now, I'm going to disagree with that, and you'll see why. And then the weaponized strategy part is really because of the adjustability of this trade and how I can adapt it quickly and easily for different market conditions by simply putting in a vertical, simply adding a vertical, taking out a vertical. It can change the whole complexion of this trade and allow it to cover a much wider area. So is the strategy best for just SPX or a stock when it's in the doldrums in a trading range? I would say yes, that may be the best use case for it. Now, I find that SPX, RUT are great vehicles for this. Stock can be, but as we know, stocks can move a little more erratically, especially around news events, earnings announcements, etc. So I don't personally usually trade these around stock, not even around earnings. I tend to lean personally toward calendars around earnings, but with the caveat that calendars are very tricky. You need to really understand how those work. So certainly don't anybody jump into trading calendars without paper trading them for quite some time first. But back to the question here, SPX is my main vehicle, RUT is probably secondary, and butterfly is my main trade. And again, whether it's an iron butterfly or an all put butterfly or an all call butterfly really doesn't make any difference. And to illustrate that point, I've gone and shown an SPX, in this case an iron butterfly, and I tend to normally do 50 point wings. Looks like actually I've got this one laid out as 60 point, but that's fine, 50, 60, somewhere in that general area. And the reason I tend to keep my wings standard is then I learn the pricing. I know what a good price is to get into one of these, get out of one of these, if I keep my wing widths kind of standard. That's the main reason that I do it personally. But here, again, we're looking at, in this case, 60 point wings. And this is an iron butterfly where I've sold the put spread and I've sold the call spread. Now, when I go to enter this trade, I'm going to enter this trade and I'm going to take in a credit for this particular trade. Now, if I do it as an all put condor, and it could just as easily be an all call condor, there might be very, very minor differences, but not much. We can see that everything about this trade is very similar. I mean, this has a max loss of 590. This has a max loss of 510. We are after hours. Bid-ask spreads are a little bit wider right now, so there could be a little fluctuation in here because of that. Max profit potential, 5410, 5490. Chance of profit, 15%. And I want to circle back to this one because it's important. Chance of profit, 15%. So, they're very, very similar trades. Now, I'm going to enter this one, however, for a debit. That really doesn't make a difference. They make their money in the same way, and they make that money through the decay of those options. And as we can see here, I've got this one 33 days in. Let's get this one 33 days in. So again, as time decays, these are going to essentially act exactly the same. Again, the weirdness of this, or you'd have to kind of do the math to understand that you're getting a credit here, and then to get your profit, you're buying this trade back because it's essentially a short type position because of these short puts. So when you buy it back, you're just paying a little less when you go to buy it back. Or the opposite is true here. I'm going to pay a debit to get into this, but I'll be able to sell it for a little bit higher amount in order to achieve essentially that same profit. So 33 days in, this one would be up 171. And 33 days in, this one would be up 144. So again, very similar. So Ron, to your question of do I have to be at or near the center strikes at expiration? No. I mean, I'm only 30 days in here, and I've already theoretically attained about a 10% profit on this trade, which is my goal or my objective. My goal and objective here is to basically get 10%, 15%, get out, move on. And I can get that when I have this very, very flat T0 line. So if this market moves up a lot, moves down a lot, doesn't make a huge amount of difference. Another thing to note here, look at how this is actually a little bit negative delta in nature. In other words, it actually gains value if the market pulls back. Now I can use that to my advantage. If I am at a resistance point in a market, I don't necessarily need the price to remain centered around these center strikes. If I'm doing a flat butterfly like this, it's awesome if the market pulls back a little bit. That actually works to my favor in this case. And the whole reason that it works that way is something called put skew, or the fact that puts tend to carry a little bit more value in general than calls carry. The reason for that is more people are buying insurance on their long portfolios. So there's just in general more put buyers out there than there are call buyers. And as a result of that, the puts tend to maintain a little bit higher value. So that's why there's that little bit of tilt, if you will, if you go downward in price. So hopefully that's cleared up the question of iron butterfly, put butterfly, call butterfly. Really doesn't make any difference. They're all going to act basically the same. Hopefully that also cleared up the fact that I don't have to be at my center strikes at expiration or near expiration. I mean, we get 21 days is, for many people, an opportune time to look at closing a trade. So let's move both of these to 21 days remaining. And let's see here. So, right in that area, up $400, and I had a total risk in this trade to start of about $500. That's almost a 100% return on my risk. And that's if we stay anywhere from 5,600 all the way down to 5,400 or so. So that's a really, really wide range. Now, the trade-off here, if I carry this to expiration, which I do not, but if I carry this to expiration, then my window is much, much narrower, assuming I never adjusted the trade. My window is much, much narrower, but I have a much, much higher profit potential in the trade. This is not my objective in the way I personally trade. I'm looking to get my little slice out of the middle here between, when I put this on and when I put it on can vary. Maybe I put it on 70 days out, maybe 50 days out, maybe 45 days out. The reason of the variance there, it depends on volatility. I could spend hours on just that subject, which I'm not going to attempt to do here. But suffice it to say, when the markets are more volatile, when volatility is higher, I tend to shorten up my time frames in these. When volatility is lower like now, I tend to go further out in expiration. And again, keep in mind that I am not trying to carry this to expiration. So when you talk about I have to are in this narrow window, well, again, not a narrow window, 5,700 all the way down to 5,350. That's a pretty darn wide window in the market. And again, that's assuming that I never adjust this. So the next most important thing about this is I would say probably only about 30% of the trades I do, I'm able to put on, take off at a later time, and never touch them, never adjust them. In the vast majority of cases, I will adjust these trades to market conditions. That's where this chance of profit, quite frankly, is a meaningless number to me, because my chance of profit on these, if you know how to trade and adjust options, my chance of profit is very, very high, probably closer to 80% on these trades, because I know how to adapt them to the market conditions. For example, if our market were to start ripping up, and under normal circumstances, I might have a loss up here, but if the market's ripping up and I feel the market's strong, it's going to stay up there, I will transfer my risk in the trade. So what I mean by that is I might go ahead and wheel this side in a little bit, maybe even something like this. Let me move my face just a little bit higher, something like this. Now, in doing this, I've taken on more risk to the downside, but if my opinion is the market is very bullish, it continues to make new highs, breaking out to the upside, I'm okay adding a little more risk to the downside here, because by the time I make this adjustment, the market's going to be up here at 5,600, so the chances of it coming all the way back down here to 5,500, not high if my read is correct. Doesn't mean it can't happen. But so now I've adjusted this in a way that no matter what happens to the upside here, no matter how far our market moves to the upside, I am guaranteed profitability here to the upside, at least $250 in profitability. So again, the key to these is not thinking about putting them on and then never having to touch them. That's not how I or most professional options traders will trade. Most of us are putting on a trade that we're comfortable with, that starts with a nice wide margin or nice wide tent, but we also then know how to adjust this as the market moves. We can adjust our tent in a number of different ways in order to accommodate how the market is moving. So for those reasons, the chance of profit is largely meaningless. I don't even factor that in when I enter a trade, because again, this is only the chance of profit if I never touch the trade, if I leave it in its current configuration, and if I carry it all the way to expiration. That's the only way software platform can attempt to calculate that, because of course otherwise nobody knows when somebody might take off the trade, etc. So if there was a way to come in here and say, well, I want to see my chance of profit if I take this off 21 days to expiration, well, that chance of profit is going to be a heck of a lot higher, because again, I can be all the way up here at 5,700, and I could be all the way down here at whatever that was, 5,300. So obviously my chance of profit if I close in that window is significantly higher. So hopefully all of this makes sense. One other little piece of the puzzle I want to toss in here, we can see right now, chance of profit shows at 15%. What happens if I come back here to July 31st? My chance of profit gets significantly higher. Well, why does it get significantly higher? Well, the reason it gets significantly higher, of course, is that if there's a shorter amount of time that we're playing with, the market is less likely to go outside those boundaries. By boundaries, I mean our break-even points in a shorter amount of time. The more time we have in this, the less likely the market is to hit, again, that little specific tent at expiration. But again, I want to stress that I am not carrying these to expiration. I'm looking to get out of them. Let's just come back to this. I forget where I was at here, September. I think I was at the September 20th, if I'm not mistaken. So, just keep in mind that at that September 20th window, my chance of profit, again, this is only calculating my chance of profit at expiration, but my chance of profit here is significantly higher. Look at how wide that is. That's what I'm playing for. So I know that was a lot. I hope it made sense. Ron, I hope I answered your questions. I hope I addressed some of the other questions and comments that have come up about butterfly trading. And again, subscribe if you find this helpful. And also, if you have other questions, comments, please drop them back to me. I do try to look at all of them. Thanks so much, everyone.